Hello, everybody. This is Patrick MontesDeOca with the Equity Management Academy weekly podcast for July 18th, 2021. Gold, low interest rates, and bottom in metals. A perfect storm for next leg up to $2,150 an ounce. Fundamentals point to a short-term inflation. Gold and silver appear to be acting the opposite of the fundamentals. A lot of money has been lost listening to the experts discuss the fundamentals. They may be right at some point, but not yet. Inflation is running above expectations, but appears to be going to be a short-term issue, not a long-term problem. Stephen Van Matre recently on his macro show reported that a University of Michigan survey found the American consumer has had enough of higher prices. Consumer Spending Intentions report from the University of Michigan found in their survey, and when asked if had planned to buy homes, appliances, or automobiles in the next 6 months, the number of respondents who said yes has plummeted. The survey was as bad as back during the 2008 crisis. The monthly change in the intention to buy a home has fallen to most since 2000. The home builder sentiment continues to fall as demand declines. The consumer sentiment and expectations indexes also fell. The stock market often tracks the sentiment surveys. Higher prices are not always inflationary. In this case, higher prices may lead to deflation as consumer decides to spend less, far less. This survey suggests that the Fed's policies may not be enough. Interest rates may not be low enough. The one-year inflation expectation has risen sharply. Consumers are saying that they don't want to buy now and they expect prices to rise in the next year, which suggests that inflation will be transitory, since demand should decline sharply in the next year. In a study of references of prices for homes, vehicles, and durables, the vast majority of survey respondents say that prices are too high, which also points to deflation. When consumers believe that prices are too high, they don't spend. We would expect that as government unemployment benefits decline, spending should also decline. A Bank of America study showed that there was little impact of unemployment benefits ending in a given state and aggregate consumer spending. So the government support of the unemployed appears to make little difference to consumer spending. A government restaurant program to support struggling restaurants has now run out of funding. It will close on Wednesday. This might mean that restaurants will start to fail even more often, putting more people on the unemployment rolls. Congress is considering legislation to add $60 billion to the program to help continue to support restaurants. Nothing has been decided as yet. The bond market is showing that bond investors do not believe that the current inflation is going to continue. Bond investors tend to be the smartest people in the room, so don't expect inflation to continue. Inventories are increasing, but with consumer intentions to buy falling, don't expect goods to continue to fly off the shelves. Van Matre concludes that he expects retail sales to crash as Americans reject the new higher prices for almost everything. Manufacturing data is rosy, but Americans are showing little inclination to spend at higher prices. Van Metre's report just highlights the disconnect between the fundamentals and the price of gold and silver. Precious metals should be rising, but they are not. Interest rates are likely to come down as the year progresses and the economy will slow down. Retail sales will fall. Inflation will slow. The Fed talked about tapering, and that led to a collapse in precious metals. If rates come down, that would be extremely bullish for precious metals and other assets that were hit by corrections. The economy cannot handle higher interest rates in the face of explosive debt we have on a global basis. If we do enter another downturn, what is the Fed going to do with interest rates already at almost zero and any talk of tapering leading to market throwing a tantrum? Be ready for a major downturn which will cause gold and silver to rise price fast. Gold is down, which is a bit of mystery. Stimulus, short supplies, and the short squeeze should drive gold up. Gold is in a major reversion from the variable changing price momentum indicator, the VCPMI. Buy 2 level of 1818 is the VCPMI daily average price. 1827 is the sell 1 level, and 1842 is the VCPMI sell 2 levels. We are down close to 1795 this morning. We activated the VCPMI buy triggers on the daily numbers. The VCPMI weekly report for silver, as produced by our proprietary Nikki the Robot, states that the weak trend momentum is bearish. A close about 25.97 will negate this bearishness to neutral. If short, you should take profits at 25.37 to 25.05. You should exit longs at 26.30 and 26.91. Looks to take profits on shorts into corrections at the buy 1 and 2 levels of 25.37 and 25.04, and go long on a weekly reversal stop. If long, use 25.04 as a stop close only and good till cancel order. Look to take profits on longs if we reach 26.30 to 26.91. The market has come down close to the buy 2 level of 25.05 in silver, is trading around the buy 1 level of 25.37. We have activated a buy trigger in silver from 25.05 by closing above 25.38. We have activated another buy signal. The target is 25.96. Nikki the Robot weekly report states that the weekly trend momentum of 1885 is bearish. The weekly VCPMI of 1813 is bullish price momentum. A close above 1813 would negate the bullishness to neutral. If short, take profits at 1791 and 1767. If you are long, the VCPMI recommends taking profits at 1835 and 1857. Gold has come down close to 1795 in the buy 2 daily level. The market then reverted from that level as Nikki the Robot suggested. Nikki said not to sell into that level. Do not go short between the buy levels. Use that area to add to your long position. Gold appears to be on its way to 1818.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.